In this week's Business Owners Corner, we're going to talk about how you can use a Roth IRA to pay less money in taxes over the rest of your life throughout retirement. So we're going to go through a quick case study here of how this works. What we're looking at is our fancy financial planning software where we're looking at a hypothetical client called Jerry Seinfeld. In Jerry's situation, he has $500,000 in cash in the bank and taxable investments, and he has another $2 million saved up in his IRA or 401k from his working years. Now, the whole reason that this is an issue is twofold. We have a progressive tax system. The more money that we make, the higher rate of income tax we pay on it. Secondarily, for these tax-deferred retirement accounts like your IRA and 401k, the money that you put in there was never taxed. The government wanted you to save for your retirement, so they extended this great tax advantage of the tax deferral. They're still waiting to tax you on that money. So what happens is once you get into your 70s, and in Jerry's case, 73, he's going to have to start paying tax on that money that's in his 401k. So from his cash situation, Jerry is 63 years old. He's just stepped into retirement. What we're looking at here is a graphical representation of his cash flow and expenses year by year. And here in 2023, what we're looking at is this red line at the top up here represents his total living expenses plus taxes. The orange bar represents how much money has to come out of his accounts to pay for those expenses. So he has some money in taxable accounts. He's going to use those first. We go along a few years. At some point, and in Jerry's case, when he turns 67, he's going to turn on his Social Security benefits, which means that his expenses go up slightly because most of his Social Security benefits are going to be taxed. That increases his expenses. And he goes on down the road, continuing to take a little bit of money out every single year to pay for his expenses. But then what happens when he gets into his 70s, and I said 73, in Jerry's case it's 75 because he's a little younger. When he turns 75, he has to start taking money out of that 401k or IRA because the government is still waiting to tax him on that money. And the way that this works for the IRS, per IRS rules, is that the older you get, the more of your account you have to take out every single year. And guess what? That distribution is counted as taxable income. So in Jerry's case, that's what this darker orange is as he proceeds into his 80s and 90s. He has to take out more and more of his retirement accounts every single year. And since all that is taxed as income, it pushes him up into a much higher tax bracket. If we're going to forecast what that looks like, and what we assumed here is Jerry lives in California, which also has a state income tax, look at the cumulative amount of tax he's going to have to pay between his current age, 63, and age 90. He doesn't need to take all that money out of his IRA, but he's forced to by virtue of the way the IRS rules work. So his cumulative taxes due between state and federal income taxes is over $1.7 million. Now, what we can do here is think about shoveling some of the money from his IRA into a Roth IRA. And whereas we have limits in terms of how much we can put into a Roth IRA every year, there are no limits surrounding a conversion from assets you have in a traditional IRA to a Roth IRA. So what that means is that if you already have money in an IRA, you can convert it to a Roth without restriction. The deal is when you do that, you pay income tax on the amount converted over to the Roth. The benefit is that if you take $10,000 and move it from your traditional IRA to your Roth IRA, you're paying tax on that $10,000 this year. That's the downside. But the benefit is once it's in the Roth, you're never paying tax on it again. You never have to take it out of the accounts again if you don't want to, because the government's already taxed you on it. So in Jerry's case, let's take a look at what that might look like. If he opens a Roth IRA and converts just enough money to put him through the 22% tax bracket, which I'll explain in just a moment, just for the next few years until he hits full retirement age and collects Social Security here at 67, he's taken enough money out of his IRA to shrink the pool that are subject to those future mandatory distributions. So they still climb and grow and grow and grow every year, but the pool is smaller and it reduces his lifetime taxation by quite a bit. And so in his situation, by opening that new Roth IRA, converting enough to fill up the 22% tax bracket each of the next 5 years, he's paying more in tax than he would need to otherwise. That's what these red bars are. But look at what happens in his later years. Because he's shrinking the pool that are subject to those mandatory distributions later on, he's paying substantially less in his 80s and 90s. And the cumulative impact here, this is not too drastic of a move, is that his lifetime tax bill is going to go down by almost $260,000. Now, he has to live until age 90 for him to reap the benefits of this, and there are a lot of things that can happen between now and then. The downside of doing something like this is clearly you're paying taxes now when you don't otherwise have to. But it comes down to the choice between paying some tax now or a lot more tax later. Now, the reason this works is because we have this progressive tax system. And in Jerry's case, before we did any conversions, he was in a very low tax bracket. These lines that we're looking at represent the different tax brackets. They start at 10%, then they go to 12%, 22%, 24%, 32%, and then 35%. And so in Jerry's case, he's in a very low tax bracket here because he has cash in the bank that he just takes out to pay his living expenses. But if he doesn't do any conversions, because the government forces money out of your IRA, he'll be pushed into the higher tax brackets for the entirety of his 80s and 90s. So if we use the room in the lower tax brackets now and pay more tax now than he otherwise has to by doing these Roth conversions, it's going to bring his tax bracket down in his later years and save him in aggregate about 260 grand. Now, this is a relatively minor example, and it could work for you if you have a lot of money parked in your traditional IRA or your 401k and haven't started collecting Social Security yet. So think twice before it. It's a relatively major move, but it could save you a lot of money in the long run.